Minutes past 10. It's a business hour. We talk about business for the next 2 hours. And in studio, I am joined by economist economist at IC Group, Chachi Logutu, and also at a council member at ISPEC, that is Wycliffe Bichanga, who will be talking to us about the pre-budget analysis of the 2025-2026 budget. We look at the spotlights and look at the key highlights of the 2025-2026 budget, as well as we look at the finance bill. This is a fiscal blueprint that will shape how much we will pay in taxes, as well as what services you will receive from the government, as well as you will know how the government plans to spend your money over the next 1 year, which is starting off in July 1st. Now, with the official budget reading set for Tuesday, that is the second week of June, Kenyans are already feeling the weight of the tough economic times and are asking, will this budget offer any relief, or are we bracing for more austerity measures? That is the conversation that our panelists will talk about this morning. And also we'll look at the tax proposals that we are seeing in the Finance Bill 2025 that have been proposed. Look at the ballooning debt levels. We'll look at the spending priorities, the high cost of living. We'll break it down, all of it this morning with our panelists in studio. Welcome to our panelists, Chachi Logutu and CPA Wycliffe Bichanga, to our studios.
Thank you.
Now, we started off with what we are seeing, a 4.32 trillion shillings budget. We are looking at how do we finance. It's a question we always ask ourselves every year whenever we are going through this phase of budgeting. From where you sit, do you think this budget is being prepared in the right way? Start with you, CPA, yes.
Thank you. Thank you, Erimo. And just want to say that this is a conversation that we should be having as a country, and I'm happy that you've given us a chance to deliberate on these issues. In terms of budgeting, I think our biggest problem has always been that we've never achieved a balanced budget. We always have a deficit. So you see, we're saying we're going to spend 4.2 against projected revenues of maybe 3.6 million, and 3.4 actually. So what that means is that we will have to borrow more to finance this budget. And the question has always been, how hard is it to live within our means? I know that when you speak to government, they will tell you that we've got to spend this much for us to be able to give you a conducive environment. For us to be able to support the 50 million Kenyans, we've got to spend this much. But if you look very keenly, what has been happening over the years is that our budgets have been increasing. At the same time, our borrowing levels have been increasing. So I don't believe that for sure we need to spend 4.2 trillion. It's possible to spend less if only we were very intentional on this. Questions have been asked that is it possible to open our budgets and clearly ensure that maybe we budget through programs, activities, so that we ensure that we are not budgeting wastage. Because there's a feeling that in that 4.2, there is a portion of the money that is going to be wasted and probably misappropriated. And yet, we do not even have that money in the first place. We are forced to borrow. Okay.
So and we'll come to the borrowing part of it. But Chachi Logutu, if we can bring you into this conversation, how would you describe the overall economic context in which the 2025-2026 budget is being prepared?
Yeah, thanks for having me, and also Wycliffe. I mean, the budget is executed within a certain macroeconomic environment. And if you look at how things have been in the last couple of years, it's been quite fragile, so to say. You look at because some of the taxes, if I may look at it from the financing side, it relies on consumption from individuals, corporates, and also the households. And if you look at even the statistics that you send from the economic survey, is speaking to the real wage income on a declining basis. So that means that even the indirect taxes haven't been performing well, and even the numbers up until April this year has been telling us that is from July last year to April this year, the kind of tax revenue that has been achieved has been dismal, just based on the fragile economic environment. So I think even the context that we are preparing the budget for the next financial year needs to be relooked at. And also you've seen even from the National Treasury, they are speaking of a third supplementary budget just to revise the budget downwards, at least for the current financial year, which means that even as we start preparing for the next financial year, there might be a bit of some realism that needs to be injected. We are also relying on the budget committee, which will also look at on the expenditure side, what Wycliffe is talking about, where areas whereby we can now be able to revise the budget. And as it is, I think it makes much sense to revise it much lower, at least to be able to accommodate the current macroeconomic environment.
Okay. And as CPA, you were talking about room for adjustment. Is there still room for adjustment when it comes to these priority areas undergoing at least substantial revision as part of the broader, maybe austerity measures designed for fiscal consolidation?
I believe so. I believe we still have time. There's still space as long as we have the goodwill to actually do it. And why I think it is also important for us to be doing what we call public participation, it's for the rest of us to put our voices and say, you know what, this is not necessarily right. And it's our belief that government is listening so that we're able to now do the right thing, because it's not sustainable to keep on borrowing.
But do you think Kenya is on track when it comes to its fiscal consolidation path?
We have seen deliberate efforts to look like we're on the right path. So it is our hope that we will actually translate, we will mean it. Because why I'm saying this, we've seen, you remember what happened in the Finance Bill 2024? If you look at this year's Finance Bill, you will see that it is a deliberate move to move away from doing the things that made Kenyans very angry with that. So you get a feeling that yes, there is one side that feels that yes, for sure we need to listen and be on the right path, but we live to see. Okay.
Churchill, what are the key expenditure priorities as you have interacted with the budget policy statement outlined in this year's, or rather in the next financial year's budget, and do they align with Kenya's development agenda?
Well, if you look at the key sectoral allocation, it's not diverting from what you've seen in the previous years. I look at the largest sector is now education, is receiving right about 700 billion. This is out of the 2.4 trillion that is going towards the national government. So 700 billion is going towards education. But you can see we have the largest employer, Teacher Service Commission, getting gobbling half of that. We have some subsidies that is going towards the primaries, secondary. We also have some of the funding towards the university and the TVETs. So that's where a significant chunk of the budget money is going towards the education sector. The other one is now at 500 billion. We have the energy, infrastructure, and ICT. And that is also coming from the fact that the road sector is getting some significant amount of money, but that is also within the development allocation as opposed to recurrent allocation towards to build the roads, some of the infrastructural projects that are in play. So to me, those are the biggest budget sectoral allocations that we've seen, and it's not deviating from the norm. So tied towards the development agenda, it's quite different, because even if you look at the whole budget process, it started all the way from August last year, and then at some point, even the respective ministries, departments, and agencies were giving their what I can call their requirements within their respective dockets. And if you look at what has been allocated so far, vis-a-vis at some point what these MDAs, I call them MDAs, were requiring, there's like a 2 trillion gap based on what we have been able to allocate to them at 2.4 trillion as compared to what they were requiring to do. So that means that there's still a funding gap in terms of the spending allocation. And this is typically the things that normally leads to the supplementary budgets, because you find that, yes, you've been given this amount of money to spend, but because of something that crops up, now you are spending outside what has been appropriated, and that's something that now leads to supplementary budgets.
looking at the spending plan, I saw the agriculture sector budget has been slashed by around 58.2 billion shillings. And you can correct me on that, far below the 106 billion that the agriculture sector had requested for. Yet here we are talking about agriculture being the backbone of the economy.
Yeah, typically, if you look at the agricultural sector in terms of the allocation, it tends to be, it's not as you would expect if you compare it from a GDP perspective, economic perspective. Because from an economic perspective side, GDP, you find that agriculture is around 24% of the total GDP. But if you look at it from on a sectoral allocation, it's even lower than 10%. So there's typically a mismatch. But you can see from the fact that some of the expenditure or the votes that where the money is allocated to are in some of the regulatory agencies. I mean, the regulatory agencies, they may not be able to spur economic growth. It's just probably increasing the regulatory burden even to the agricultural sector. So these are some of the things that are coming out to the fore in terms of the mismatch between, yes, we have this agricultural sector that is big, but what are the incentives that we can see in the budget sector that can now be able to stimulate the agricultural sector? So that is where the mismatch is missing. So we might talk about X amount of money being given to the agricultural sector as a whole, but to find that a significant chunk of that is now going to regulatory authorities rather than the farmer on the ground, so to speak, or a fisherman down there.
CPA, picking up from where you left on when you were talking about debt vulnerabilities, and we saw in the budget policy statement there's a budget deficit of 4.3%, or planning to reduce it to 4.3% from 5.3% to 2.7% by 2028. But at the time when you look at the budget, there's a slightly increase in the spending plan of the 2025-2026 budget. So the question is, does the budget prioritize to reduce debt vulnerabilities while ensuring adequate funding for essential services?
I agree with you. It's always a tight balance, trying to look at giving your priority areas, trying to achieve the services that you want to achieve, and also at the same time trying to reduce your debt exposure. It has to be a balance, and that is why some of us have been keen to say, can we look at the expenditure bit, so that we know that as we spend, even as we say we are going to achieve our priorities, we actually spending the right amount. Because, and that is why I was keen to say, is it possible that there is wastage budgeted in there, so that we don't affect service delivery, but we affect any wastage that is in there. If you do that, you're going to achieve two things: that you're able to deliver, but at the same time, you're able to reduce your debt exposure, because we have to be worried about the debt levels.
Yeah. But so we are borrowing more from the domestic market than from the external market. Will that crowd the private sector lending?
Absolutely. Because when government borrows more from borrows more domestically, what happens is that the banks or even the lenders do not have the appetite to lend to you and me. And yet, it is me and you who is going to spur production in the country. So a typical business person setting up a manufacturing plant in Australia needs funding to be able to set up his factory, and the ripple effect is huge. Because when I set up a factory, what is going to happen is that I'm going to employ more people and get more money into the economy and increase our GDP, because we're talking of now increasing production. But if I do not have funding, I'm probably never going to set up that factory. So that's the danger of government borrowing locally, because they lock the rest of us out.
All right, I was about to cut you short because we were about to go to the unveiling of the government litigation committee at State Law Office. The Attorney General was addressing right there, but we'll play that clip later on in our broadcast, so do watch out for that story in our various bulletins during the day. Now we continue with CPAs, what you were talking about, ensuring that we focus on areas that are bringing in money, that is manufacturing sector as well as the agriculture sector. But having interacted with the finance bill, CPA Wycliffe, does it close the loopholes and enhance efficiency in spending, including addressing those tax expenditure which has historically been exploited?
Yes. This finance bill has specifically done exactly that. It has been very keen to do a cleanup. And we've also seen deliberate attempts to reduce the tax expenditure. So the tax expenditure is basically the taxes that the government forgoes. So if I give you a relief somewhere, that becomes a tax expenditure to the government, because ordinarily they could have gotten this money. And we've seen that happen because we've seen a number of items being moved from the first schedule of the VAT Act, that is being exempt. They have been moved either to standard rated. So that is an attempt to actually reduce the tax expenditure, and that is also stipulated when you look at the medium-term revenue strategy. That has been very clear that we have to reduce the tax expenditure, which is when you look regionally, I think we have the highest. It stands at about 3.3%. So that has been achieved, and has been achieved, and I think this also started last year in the tax amendment bills of 2024. So we've seen that progressively coming in. We've also seen certain cleanups being done through this finance bill. When you read the whole finance bill 2025, you realize that the major part of it is just a cleanup, which is desirable, because we enacted tax policy, which has also we've not been following it, but you can see a deliberate attempt to go that route.
Okay. Churchill, what are your thoughts on the new tax proposals in the Finance Bill 2025, and which one stands out for you? And also, from where you sit, are these tax measures realistic in terms of budgeting?
Well, so looking at the bigger picture, you find that from where we are in the current financial year, the target revenue is around 2.58 trillion. And then you're moving to 2.76 trillion for the next financial year. So already there's an increase of 176 billion. So out of this 176 billion, you find that the tax laws amendment and also the tax procedures law that came in effect in December is expected to raise right about 70 billion. So you have a gap of around 106 billion. So, and what we have been informed by the National Treasury is that the finance bill is actually coming in to net in around 30 billion.
Allow me, Churchill, to cut you short. We are going to go live to the LSK office. If you can go right ahead.
Carrying out this assignment because we'll be watching. They hope that they can get resolutions to aid the various matters that have been lounging in courts for years. Thank you.
Attorney General, the American Commission, I'll now invite members of the states. Should there be any questions, clarifications, and I respectfully request that we limit this one. Thank you. Members of the states.
From Kayo? Yes.
One of the questions that the committee has can you maybe elaborate about this case for the Kenya?
Yes. For the timelines, we are giving them 3 months. As the government has a guideline on RRIs, Rapid Results Initiative, and it limits it to 100 days. We are trying as much as possible to limit ourselves within those 100 days. But even before the 100 days, should we have resolutions or have them up? Give the impression that the
That is the unveiling of the government litigation committee right there on your screen. And he they're speaking from State Law Office right here in Nairobi, and our reporter has pitched camp right there, and he will be bringing us the story later on in our broadcast. Now, back here in studio, we continue with the conversation on the pre-budget analysis of the 2025-2026 budget. It's a budget that you have interacted with right now. People are giving their views on the budget, so you better give your views on what you think about the Finance Bill 2025, as well as the various proposals that are in the budget policy statement. And picking up from where we left Churchill Ogutu, we're talking about the financing of the budget, and you were giving us the various tax proposals that are mentioned in the Finance Bill 2025. From where you sit, are they realistic?
Yeah, thanks. Let me pick it up from where we left it at.
Yes.
So the Finance Bill is expected to raise 30 billion. And if you compare with what Finance Bill 2024 initially was targeting, 345 billion, so it means that this one is now looking at how things are, just trying to be amenable even to the public. And to what Wycliffe has said, is pretty much a cleanup. Hence, it's not able to yield much as compared to the other iterations of the Finance Bill. But having said that, you look at even some of the proposals, because ideally, we have the medium-term revenue strategy, which is supposed to be able to yield around 20% of GDP. Right now, we're around 16% of GDP in terms of revenue to GDP ratio. So, but I think it's now the National Treasury has somewhat put a halt on trying to accumulate more revenue because of the pushback that they may be able to get. But speaking of some of the things that you have seen in the Finance Bill, obviously within the indirect taxes, there's a bit of some cleanup, moving from the zero-rated to tax-exempt, and also some of the commodities being moved from tax-exempt to standard-rated. On the income side, you've seen even efforts around the carry-over losses. Initially, it used to be indefinite, but now it's been limited to 5 years. There's some reduction in the corporate income tax in some of the motor vehicle assemblers, so it was around 15%. So that one is now being shelved off, so might be even affecting some of the industries. So, I mean, but if you look at it generally, it's quite a cleanup, pretty much. There's one contentious one is where under the tax an amendment trying to look at the Tax Procedures Act, whereby KRA will now be allowed to come in and have some visibility in the trade secrets, and also touching on some of the data areas. I think that is the most contentious clause within the Finance Bill. But other than that, I think it's not as the whole Finance Bill is not as contentious as Finance Bill 2024. Okay,
but CPA Wycliffe, if I may be bringing you into this conversation, are there concerns about overtaxing the shrinking middle class and also the productive sectors like the manufacturing sector as well as the SMEs?
Yes, I must say yes, and even referring back to what Churchill just referred, the medium-term revenue strategy, the whole idea was that we progressively reduce our taxes because there is a very clear correlation between taxes and production, so that when your taxes are low, you are encouraging more people to produce. The medium-term revenue strategy talks about progressively getting the VAT rate to 14%. So there was even expectation from our side that this finance bill was going to give us maybe a 15% tax rate for VAT, because we believe that the more you reduce the tax rates, the more you are going to encourage more people to comply, and also more people get into business, produce more, and you may even end up collecting more. So in terms of are we overtaxing people? In fact, I just want to talk about the PAYE. We were expecting, some of us were expecting, that there was going to be a revision on the tax bands, the PAYE tax bands, because we have a situation where we have 10%, 25%, 30%, but you get to 30% at 32,333. Anyone earning above 32,333 is taxed at 30%. Then we saw the Finance Bill 2023 had introduced 32.5% and 35%, which we also expected there was going to be an adjustment, probably do away with those high rates, because when you tax people up to 35%, you are reducing consumption because the disposable income is affected. And this also will affect your other taxes, particularly the consumption taxes. Because if you do not have that money, you're not going to spend, you're not going to pay VAT. So we've been giving suggestions that, you know what, let's look at having our highest band to be maybe the 30 that we used to have, or even lower, so that we're able to have more disposable income, so that we can end up collecting more in consumption taxes. But we've seen that this finance bill was quiet on this. We still have people being taxed at the 35%. We still have 32.5%, and we have people progressing to 30% quite fast. We've done, some of us have done a comparative analysis regionally. You will be surprised, Werimo, that in Ghana, the equivalent of our 32,333, where you get taxed 30%, in Ghana, you will have to earn up to 265,000 for you to be taxed at 30%, which makes sense. But even if we're not to get to 200,000, can we at least have somebody earning 100,000? You get 200,000, that's when you get taxed at 30%, because our tax bands are quite narrow, and that is a big concern.
Okay. Churchill, there's been a persistent issue of taxing the informal economy. And of course, the government has been trying and deploying measures to ensure that the informal economy are part of the tax band. But when you look at the finance bill, does it in any way try to bring in the informal sector so that it's not only a section of Kenyans that are funding this country?
In my assessment, I'm not saying that. Because if you look at it in terms of direct taxes, by direct taxes, we're talking about the corporate income tax and also the pay-as-you-earn. I mean, those is within the conduit of the formal employment, be it corporate income tax, is a bit hard now to tax on the corporate side, some of these businesses, enterprises. And also on the pay-as-you-earn is just strictly within the formal employees. So now the thing that remains is now on the indirect taxes. So that speaks to the VAT and the excise and the likes here. So you can make an argument that it's somehow even affecting them. If you look at some of the proposals that have been contained, which is broad-based, things such as on the excise duty, there's some revision in the spirits. This is some of the commodities that the informal sector employees consume as much as the formal employees. And also on the VAT, there are a number of some of the proposals which will also touch them. So I can't say that that directly it might affect them. Well, the argument that can also be made is also some of the digital taxes that have been introduced, but also that one is pretty much touching on the formal establishment as opposed to the people within the informal sector. So that's what I'm saying. It's still challenging to tax. Finance Bill 2024 had proposed now the 5% withholding tax on the agricultural produce, but we know that that was shelved off. We haven't seen it being introduced. We didn't see it introduced in the tax laws amendment that came in effect in December. We haven't seen any kind of iteration, at least to be able to target the agricultural sector. We haven't seen that. We've seen some proposals within the input sector, within the inputs of the agricultural, but that is not within the informal sector. So broadly, I'm not seeing anything tangible or significant that is affecting the informal sector.
Okay. Talking of the digital marketplace, which you've mentioned in your response, there's a proposal to amend the Excise Duty Act to clarify goods and services supplied on the internet or an electronic network. What was there previously?
I think this speaks to the cleanup that we are seeing. Just each and every finance bill, you find that there are normally some revisions in the definition, be it largely recent past, we've seen largely now targeting within the digital economy. So there are normally some tweaks that keeps coming by with each and every finance bill around the digital sector. We've seen, just case in point, at some point we had the significant economic presence tax that was reintroduced or proposed to be introduced. I think it was Finance Bill 2024. Now we still have the digital asset tax. But now the proposed tax rate has been lowered from 3% that was there to around 1.5%. Let's see what the Finance Committee will make an argument on that. But broadly, there's been a shift towards targeting the digital economy. So it's not a surprise, and it will not even be a surprise even in future finance bills, some revisions, some tweaks to be able to target the digital economy.
Okay. CPA, Wycliffe, there's a proposal, and we're still looking at the various tax proposals in the Finance Bill 2025. Looking at the real estate sector is something I would like you to chip in, and I know there has been comments in the past couple of days regarding this section, or rather this proposed rate. 16% VAT on construction materials. Previously, construction materials were zero rated. What would be the impact of this on the affordable housing agenda?
Yeah, I think this is one of those proposals that we said what is happening is that government is keen to reduce the tax expenditure, because when it is exempted, it means that government is foregoing that VAT amount on that. So they are very keen to just reduce that, but then at the same time, they are scoring their own goal, because this government has been talking about the affordable housing for a very long time. So we could have expected that you keep on incentivizing people to continue constructing houses, affordable housing. But then you come in and say, you know what, we're going to standard rate this. So that means you may not achieve your target on the affordable housing as it was. But I think the main question here is, even when it was exempt, how many people were actually benefiting out of this provision? Because it wasn't as straightforward as we think it was. There were very few people actually benefiting out of this. Maybe getting clarity on this, saying, you know what, this is standard for everyone, let's do what we've got to do, maybe is a good thing. Okay.
What of the 15% preferential corporate tax for developers constructing 400 units and more annually?
Yes, it is a similar thing.
It's a similar thing.
So what they have done is that they have cleaned it up from VAT and also income tax. So there are people getting preferential rates, 15%. They are being told, you know what, you are not any special. We can somehow still do our houses. My own thoughts on the affordable housing is that if we were able to sort other areas, for example, sort our infrastructure, maybe the affordable housing could not be an issue, because if your infrastructure is really good, people can live wherever. People can construct houses. You know, if you are able to move to Nairobi from Nakuru on a daily basis, when the infrastructure is really good. So in my own thoughts is that we need to start thinking long term, that in 5 years' time, how do we want to sort our housing? Do we want to construct houses around towns, or do we want people to live wherever they are, but we sort our transport system so that we interconnect the various cities and sort the housing problem permanently? Because we have people in this country who have 4 homes, because you get yourself here, you do a home, but then you realize that you cannot move from that home to your workplace, so you've got to move again. So if we sorted the infrastructure, we shall have sorted many of these issues.
Okay. I don't know whether, Churchill, you agree with what CPA Wycliffe is talking about, sorting the infrastructure, and you can live anywhere, sorting out the affordable housing gap that is in the country. I don't know what your thoughts are in regards to what he's saying.
Yeah, I fully agree with him. If you are able to sort the infrastructural projects, the infrastructure, it can come in and also reduce even the, come in and partly address the issues that the affordable housing projects is trying to do. And if you look at it, in terms of the demand of the affordable housing, you find that some of the houses are being built in some far-flung counties, which you try to look at the economic sense of it, it might not, it doesn't even make sense. And that now speaks to the numbers that you've seen even in terms of the affordable units that have been constructed. The goal is now to do close to 200,000 units a year, but you've been punching below our weight, less than 10,000 units a year. So at least now we're starting to see some progress, but still it's below the 200,000 units per year that we're talking about. So that speaks to about the issue about the demand of this affordable housing that we've been talking about. So if you are able just to do infrastructure, even the private sector will just come in and do this affordable housing units on their own without even the interference of the government initiatives. So I think that needs to come, that also comes in. Tied to that, there's also the reduction in the export promotion and investment levy from 17.5% to around 5% thereabout. So that one at least is going towards meet the bigger construction industry, not just the affordable housing. So I think that's a welcome relief to that particular sector, which has been slowing down over the last couple of quarters.
Okay. Are there measures in the finance bill that are addressing the manufacturing sector? You know, we've been talking about growing the manufacturing sector from the current 7% to 20%, but it's been slowing down over the years. But when you look at the finance bill and having interacted with it as CPA Weekly, what have you seen are the proposals that are addressing this issue?
In this finance bill, I will actually say I have not seen proposals that are supporting the manufacturing sector, which is a little bit disappointing, considering that even when you look at the GDP contribution over the manufacturing sector, it has been declining over the years. And you will think that deliberate moves will be made to support that sector. I just want to then talk about what Churchill spoke about on the tax losses being capped at 5 years. That, to me, will be a move that will discourage the manufacturing sector and other sectors that need heavy capital investments. Because if you invest heavily in terms of billions, and for whatever reason your business doesn't pick up in 5 years, you're going to have capital allowance, losses due to capital allowances. If you've done, you know, the machinery, big machinery that you've put in, you've had to do infrastructure developments for your organization, you're going to have capital allowance losses, capital allowances contributing to your tax losses, which you will be comfortable in an era where you know that you can carry your tax losses going forward, maybe for another 7-6 years. But when you're being told you must utilize these tax losses within 5 years, what is going to happen? You're going to be shy from investing heavily. So that, to me, is another area that is going to affect manufacturing negatively.
What of you, Churchill? When you look at the manufacturing sector, it's been, as CPA Weekly has said, the growth, or rather the contribution to the GDP has been declining over the years, but yet there's nothing being done, or whatever is being done is quite insignificant for us to notice. So from where you sit, does the bill as well as the proposals in the budget address these issues that our manufacturing sector are facing?
Not really. The target is manufacturing as a share of GDP should be 15%, but even when it came in, that was 2017, that was when this particular goal came in place within the bigger Vision 2030. We've been still at 7%, so it doesn't address, even if you look at the finance bill proposals, and also if you look at even on the spending side, what has been allocated towards manufacturing is even below 50 billion, so it doesn't even address some of these issues. So I think it's more that needs to be done. One, you find that manufacturing has linkages to other sectors. It has linkages to the agricultural sector. It also has linkages to some of the other external sectors, be it the apparel, what you're saying within the EPZ sector. But what the environment that we are in right now, we have the tariff wars coming in. We also have AGOA, African Growth Opportunity Act, which has boosted the EPZ and in a way also the agricultural, the manufacturing sector, but there's a likelihood it might lapse when it's coming due in September 2025. So how is the government positioning itself to be able to at least stimulate this particular sector amidst the probably expiry of AGOA and also the 10% tariff wars that is playing out across the globe? So I think the interventions that needs to be done is even outside the budget. It needs now to be more forward thinking, even in terms of negotiations between the Kenyan government and the US, at least to revive that sector. The other sector is now on the other sectors, such as on the agricultural produce, which has linkages to the manufacturing. I think also more effort needs to be done towards those areas to be able to revive the manufacturing sector. As it is more than some of the tax incentives that is there, because now the government is even looking at reducing some of the incentives on the tax side to the manufacturers. So it's more of, okay, how is the business environment supportive to them? Is our cost of power as conducive to support manufacturing? If it's not, what needs to be done? So those are some of the things that even over and above what we're talking about in terms of the budget initiatives that needs to be addressed.
Okay. CPA Wycliffe, with Kenyans living on the edge, with the high cost of living, increased taxes, does this budget support economic recovery and long-term growth? Picking up from what Churchill Ogutru has talked about, various sectors, priority areas.
Yeah, so I will say yes and no. That there are those areas that when you look at the intention, you can then see that this supports us. But I will say no in terms of just supporting what Churchill has said, that we've got to see deliberate moves to have a mindset of production, that are we going to increase production? So, for example, we've got to address our power needs, because we know that our power needs in the country are high. Our cost of power is high. How are we being deliberate in terms of reducing the power? We know that when tax rates are high, PAY rates, I mean, the labor cost goes up, because if I need to give you a net figure of X amount and the tax rates are high, so I need to give you a higher gross amount. If those rates were adjusted, you're going to see labor cost going down in the country. So when you have the labor cost going down, you have more people setting up in the country to spur economic growth. We've got to be very deliberate on these needs. I think what we've seen is that we are a little bit conscious. We do not want to reduce rates, because we think if we reduce rates, we're going to lose out on the overall amount collected. But some of us believe the effect will be the other way around, that if you reduce your rates, you're going to encourage more people, you are going to encourage in the long run. So we need to stop looking at it in the short term and look at the long run, that we're actually going to spur economic growth if we were deliberate on these issues and reduce some of these things. Okay,
and to spur economic growth, of course, we have to bring in the counties into the picture. And of course, they are set to receive about 436.7 billion shillings. Is this sufficient to support effective devolution, as well as some of the sectors that have been devolved, like health sector?
Well, if you look at the equitable revenue share is around 405.1 billion to counties, and there is normally some additional amounts that is conditional allocation, so that works to around the 436 billion that you mentioned. But then again, there's normally this tug of war between National Treasury and National Assembly and the Senate in terms of the equitable revenue share. At some point, the Division of Revenue Bill, which now splits what goes to counties, was contested because of Senate wanted a higher allocation, I think 465 billion. So this plays out, I mean, we've seen this movie before, that National Assembly, because it's fixed, is able to allocate much to the counties, whereas Senate, which is now having the oversight duties to counties, is requiring more amount than that. So this keeps on playing out year in, year out. But I don't know what the final figure ultimately will be in terms of equitable revenue. But there is need of because of the 2010 Constitution of Kenya, there were some devolved functions that went to counties, such issues such as on the medical side, the health sector is pretty much been devolved. So we need to see that even some of the allocation that is going towards the counties is able to address some of the devolved functions, rather than having them addressed from the national government side. Yeah. So it's one of those things that we've not been able to fix as a nation. And also in terms of the actual equitable revenue share to counties, there's been some delays. Last year, we also had some carryovers that were not able to submit around 32 billion. That year was 29 billion. So even in as much as we're talking about 405 billion as the equitable revenue share, we also need to ensure that these monies are disbursed on time. Otherwise, now counties which are handling some of the critical functions might ground to a halt.
Okay. CPA, when it comes to spurring economic growth and counties being a key contributor to this, we have seen the county aggregation centers being put up in all the 47 counties. And speaking to where you left off on spurring the manufacturing sector, when you look at the proposals for the special economic zones, as well as other incentives to ensure that they will bring investment into the country, are we likely to see a growth in the near future?
The aggregation centers is a story that I think we're very keen to see how it ends, because we've seen them being set up, we've seen foundation stones being laid. I do not know any county that has actually successfully developed that. So we've seen pledges, the county is going to put in 100 million, national government X amount, but I do not think any county has actually successfully succeeded in or rather completed construction of the same. But if they were to be completed as the plan is, then I think it's a good way to sort of devolve industrialization to the counties, because we have a situation where Nairobi, Thika, I think, and Mombasa are the major industrial towns in Kenya. But is it possible to have these taken down to the counties, being able to create employment at those levels? And that will also help us reduce other pressures, like the housing pressure that we see, because we're going to have employment there, so we may not need to all travel to Nairobi to look for employment. So if that works, when it works, we will be happy, and I think it's a good thing. However, I must say that as a country, and I've seen a few people come up with this discussion about viability, economic viability of our counties, and I strongly believe it is time to have that conversation as a country. That we have 47 counties, we have 436 billion going to the counties. When you look at that amount, how much of that amount is used for recurrent expenditure? You will realize that we have most of it goes for recurrent expenditure, and that brings in the economic viability, because if we spend a lot of this money paying salaries, and what these people are doing is the same duty that is being done by someone else, is it possible to just have as a country, to just aggregate our counties and probably have, somebody was telling me that 16 will be a good number, so that we avoid duplication. Recurrent expenditure will just be standard. We spend more money on development. Okay. I believe it is time to have that conversation as a country. As we come to a close, and I would like to hear from both of you, how can the government ensure that allocated funds are reused efficiently and for the intended purpose, and also to seal revenue leakages? Let's start with you, Churchill. Well, it's a timely conversation, and even what played out last year around the protests was speaking to the efficiency of government expenditure. So it has to be given some emphasis.
The only thing is that when you talk about the budget, is now talking about the priority areas, the budgetary allocation. But after that, unless now you start looking at the quarterly reports that come from Treasury, and also the Auditor General reports that come after 12 months after the end of the financial year, and also after that we have the parliamentary committee that looks at the budget execution. So it's not, we don't have a sense of real-time efficiency of some of these things or some of the government expenditure. So, but ultimately, we need now to review them to be able to ensure that there's some efficiency. A case in point is South Africa. Timely, they are going through the budget process, but then they had to redo the budget 3 times this financial year. But one of the things that now they are keenly looking at is now efficiency. And they've come up with a time plan of reviewing the projects, the programs that are funded, and knock out some of them which are not efficient. So if Kenya can go that similar route, I think it will be helpful on the long haul.
Thank you. As we come to a close, your final thoughts on ensuring that the funds are being used correctly?
To me, we've got to make use of our constitutional offices. We've got to take seriously reports coming out from the Auditor General's office and the Control of Budgets office. We set up those offices for a reason. And it sickens me to see that those reports just come out and nothing happens out of it. As ISPAC, we did an analysis recently on the reports produced by the county governments across the country. And you will be surprised that very few counties got the qualified opinion, unqualified opinion. So that tells you on the lot that we have out there. But no one talks about it. So we really must use the reports coming out of our constitutional offices for us to go forward.
Thank you so much for that. That has been, or has been, or, that is actually CPA Wycliffe Bichanga, who is a council member, ISPEC, and also Churchill Ogutu, economist at IC Group. We've been with us for the past 1 hour as we talked about the 2025-2026 budget analysis. This is a conversation that is not ending here. We'll continue until the 12th of June, when the D-Day, the day that we'll be expecting John Badi to present to us the budget